In this video, I'm going to analyse Lgen General Stock by giving my thoughts on the business and whether I would personally buy Lgen shares right now. This week, I was planning to cover Hargreaves Lansdown stock. However, this week I've decided that I'm going to postpone it as there is a greater demand for Lgen, and a lot of people had mentioned it on my how many shares of a stock you should own for £100 a month in dividend income. If you're interested in that video, I'm going to put the card at the top right of the video there for you for later. And if you enjoy the video or find it useful, please show me one of these to support the series. Lgen General provides various insurance and services worldwide. They are a very diverse financial business, not only providing insurance services such as health or life, but rather even loans such as lifetime mortgages, and even retirement products or actively managed funds, passive index funds, or even real estate funds. Lgen is listed in the FTSE 100, has a market capitalisation of £14.8 billion and has around 8,523 employees as of December 2019. Usually I would take the time to mention what type of a market structure the typical business is in. As with Lgen, it's very complex, and as far as I know, I believe it to be in an oligopoly. Although, if you know any more than I do, I'd love to hear what you would say this market structure is down in the comments section down below. But since I would suggest they're in an oligopoly with a very fragmented competitor landscape, meaning they're in so many industries and so diverse that it's very difficult to track their market shares between all of them. However, they are suggesting that they are market leaders in the major industries, with typically market shares of 20 to 40%. And this includes risk management, bulk annuities, life insurance, and also retirement products. And they are competing with the typical financial companies that you would interact with in the UK, such as AXA or AXA. You have Aviva. You also have Prudential. When looking at the price to earnings ratio of Lgen, we can see that it is actually less than that of the industry and also the market. This can suggest to some investors that this stock is undervalued. However, what it also tells me is that investor sentiment with this stock is actually lower, meaning that investors are less willing to pay a premium for this stock. On the other hand, when we compare their net assets to their market capitalization, it would actually show that they are overvalued. Although, once more, this is a financial company, so they likely have to write off some bad debts as liabilities, which will likely take away from their net asset position and therefore make them seem more overvalued than they typically are. And it's not a massive incline above that of their industry or the market, and so I would consider that to be fair value. In the last 5 years, they've managed to grow their earnings by a compound annual growth rate of 10.2%. which is quite impressive when you account for the negative earnings decline this year of 34.7% due to the pandemic crisis and the uncertainty that it brought. Despite this, Lgen still has a respectable profit margin of 8.1% and a very impressive free cash flow of around 40% of their total revenue. If you'd like to get started investing, sign up to Trading 212 using my link in the description down below to get a free share worth up to £100 when you deposit just £1. Arguably, the strongest part of the investment with Lgen General is in fact their dividend. They are very much committed to this and proved it during the midst of the pandemic. Whilst the financial regulators were very much clawing our financial institutions, telling them that you must suspend your dividends so that you can increase your liquidity and therefore give out more money, therefore stimulating the economy, Lgen actually decided to continue paying their dividend, which was a bold move at the time and proved to be quite a valuable move for dividend seekers. Lgen has a current dividend yield of 7.08%, which is a biannual payer, typically paying in June and September each year. Usually though, the higher the yield of the investment, the more risky it is seen as. So we need to look at the payout ratio to really effectively judge this. And looking at their payout ratio, it is 84%, which tells me that 84% of their current earnings is invested into their dividend and the other 16% is reinvested back into the business. This makes sense, however, because this is a mature business that doesn't really benefit much from reinvesting this money. That's because if we look at their return on capital employed, it is a very, very low figure. And effectively, they would gain more from investing their money into the dividends than they would from reinvesting it back in the business. As they are a very high cash generative business, and as you know, insurance is very much like that, as people are constantly paying money in and they may not receive that premium to a much longer period down the line. But it is also worth mentioning that this payout ratio is artificially inflated due to their negative earnings decline. and at the moment it may be a lot higher than it typically is. In fact, over the last 20 years, their dividend payments have been very reliable, with the exception of the great financial crisis and the aftermath of it in 2008 and 2009, in which they had two consecutive dividend cuts. However, they weren't substantial cuts and they were consistently paying a dividend income during this time. Furthermore, since then they have not cut their dividend once and have had an impressive growth rate. At least over the last 10 years, they've managed to get a compound annual growth rate of their dividend of 15%, of over 15%. Although more recently in the last 5 years this has certainly slowed down, this is still very impressive, and in fact according to dividenddata.com, this ranks them number 6 in their 10-year dividend growth rate in the FTSE 100. That's quite impressive and a good income stock to have in a portfolio, especially because it's got such a high yield already. However, we should really look at the quality of their balance sheet. If their payout ratio is to continually remain this high, perhaps even go above 100%, then we need to know if they have a reliable position of cash to rely upon if this should occur. And when looking at the quality of their balance sheet, obviously this is a financial company, so there will be some differences here. We can see that it is a good but not great balance sheet. This is because their short-term assets outweigh their short-term liabilities, but not their long-term liabilities. And this is because I very much suspect that these financial institutions have to write off a various number of factors, including things like bad debts. This is where they are loaning out money, but are very likely not going to be receiving that money back, and therefore they must write it off, and therefore is likely chalked up upon as a liability, therefore making the balance sheet look a lot worse than it potentially is. However, what we can see is that they reduced their debt load over the last 5 years. It is at 61.9% currently, but that's not bad. They have a very impressive cash position of £21 billion, and it is in a good state and means that they could draw upon this cash position should they struggle to get earnings in the next few years. There is a risk for this stock, and that's not necessarily with the company itself, but rather the investors. This is a very complex financial institution, making it very difficult to understand and comprehend. Furthermore, the management of this company may struggle to generate effective returns on all of their individual industries and claw up market share or remain market leaders, simply because they have to diversify their attention. Furthermore, for investors, this does make it much harder to research. It may lead to you having less confidence on the business as you simply know less, or maybe you're aware that you know less of the business. And therefore, if you have less confidence, you're more likely to sell out during a market crash, and that's what had happened earlier in the year. And very much so, Lgen is still very much down year to date. I also feel that this means the stock will be more volatile, and that means if the market goes up by 10%, Lgen, for example, could go up by 15%. But if it drops by 10%, Lgen could also drop by 15%. Whilst it's never exactly to this measure, I do suspect that Lgen is a lot more volatile than the markets, and usually with high volatility means high risk, which could also mean high reward. If we look in the last 5 years, they had managed to generate returns of around 28%, 28.2% with dividends reinvested, which only marginally beats the market, but does beat their industry. This isn't too great considering the high volatility and risk involved. However, what I can see is this is a high yield opportunity, and when we look at interest rates at the moment, which are at all-time lows, bonds aren't really doing that well either, then this could be a suitable replacement. What we can see is that over this time period, it has effectively preserved your capital, and therefore meaning that you've invested this money in it. I think you've lost around about 1 to 2% if you hadn't have accounted for those dividend returns. You can draw off a fairly substantial income and continue on with retirement, for example. Although you will be trading this dividend income for that minimal growth. However, if in the future, and obviously we've had Brexit, we've had the pandemic, so there's been a lot of factors that would be pushing the share price down. If in the future they're able to just grow their share price by above inflation, effectively your capital will have the same spending power this year as it will next year or decades down the line, and therefore it would be great for you as they're growing their dividend at faster paces than the rest of the market, but also able to pay that reliable income. Obviously the downside is that the payment dates are June and September. These are very two close periods together, and there'll be a large period of the year in which you will not be receiving dividend income, so it will require you to either budget effectively, or it means diversifying your investments into other stocks. And so I feel if you are nearing retirement, I very much think that this is an excellent stock to acquire. And if you are in retirement, this could be an even better one for you. But then it doesn't just end there. I also feel that if you've got a portfolio that you actively manage and you constantly look between different stocks, it's not a bad idea to have a high yield dividend stock in your portfolio that will reliably pay you dividend income, perhaps in a time of market turmoil. That way you can reinvest those dividends, get great value on it, or just let it build up your cash position. I, in the past, had actually held Lgen General, although I had made the mistake of selling it very early. And in fact, I had invested that into Aviva instead. I no longer hold either of these positions, and the reason I will not be buying Lgen at this current period of time in my investment ISA is because I hold London Stock Exchange Group, and I don't want any more financial companies than that. However, I could see this as a place in a general investment account, and this is to take use of the capital gains tax of £12,300 and the dividends allowance of £2,000. If you had enough shares of Legal & General in there, you could likely keep it at £2,000 of dividends a year, siphon that, keep that tax free, and then sell off the investments that go above that, and therefore not be taxed on the capital gains as it's a high enough yield and dividends should come first. If you're interested in my Rolls-Royce stock analysis, then click the card at the top right of the video. I'm Osborne Foreman, thank you for watching, stay safe.